on neckline. Now this pattern happens in a downtrend. It's like a downtrend and the price is falling off. And you see this pattern. On neckline pattern consists of a red candlestick, immediately followed by a small body white candle. The second candle has a lower low than the first candle. So basically the lows are broken. It is considered as an extremely bearish pattern when the low of the green candlestick is penetrated the next day. So basically it means it's a continuation pattern, the first thing. Second, although on the day it opens lower and then closes higher, but it's still lower than the close of the red candle. And the white candle's low, the green candle's low, is like breaking the red candle's low. So the lows are getting lower. And the green candle's high is usually not that strong to cross the red candle's high. So basically everything is continuing down. Once you see this pattern, it means the next day will be like more fall. And once it crosses the low of the green candle, then it means like a sure thing of a downtrend and easy money to be made if you can short sell on the low of the green candle. Now we will discuss it on chart so that I can show you how on neckline really looks like on a fall. On neckline. Now on neckline is a really good pattern. Now what really happens is that the stock is falling. Okay, the trend is lower. It is basically going down. Example right here. It opened at 1267 and closed at 1227, the close. Next day, it opens lower at 1199 but closes above it at 1220, which is near the open of the previous day. Now what really happens is, in a neckline, the first candle is red candle and the next candle is it opens lower and comes back up, but it never crosses the open and usually closes near the low of this day, red candle's day. And as you can see, this close is lower than this open and approximately near the close. Now this is a downfall pattern, and as and when it breaks this low 1196, the low of this green candle which has opened lower 1196, once it breaks that, example here, this means extreme bearish, and that's exactly what happened. This candle closed at 1198 and the next day it touched 1099. That's $1 down. That's what, 10% down. Huge fall. Again, the same example right here. This day it opened at 1376, closed at 1354. The low is 1349. The next day it opens lower at 1345 and closes at 1353, which is below the close of this red candle. So it's again on neckline, and as we discussed right here, once it breaks this low of 1337, it falls, and that's exactly what happened. It touched 1305, the low. So it's a 30-cent fall. That's huge. That's 3.33% within a day. So this pattern is good for making short-term gain, an easy gain. It usually means a downward trend. And that's how you can make easy money. Thank you.